Stepping back gives you perspective, gives anyone perspective on what's going on. And in the world of investing, it's very hard for the human brain to step back and say, hey, what is going on, what's working, what's not working. And mostly that's because of the amygdala, the part of the brain that manages our emotions and wants to keep us safe, can hijack our prefrontal lobes immediately, easily, and quickly and take over, causing us to not want to step back and take kind of a big picture view. And so with that, I was on a call with a client talking about I have two main jobs when someone hires me. And one job is to not lose purchasing power to inflation, and one job is to not have capital losses. So it's the first one I want to talk about, inflation, because, well, you can't really see it necessarily, right? There's not really a chart that you see each day. I mean, over time you can see it if you're paying attention, but it's kind of an invisible tax on all of us, especially considering that the Fed, that central bank of the United States, they want 2% inflation, right? So if you have $100,000, they want that $100,000 to buy $98,000 worth of goods after the first year. And they want that to go on and on and on until eventually that $100,000 has a purchasing power of $50,000. Even if you visually can see in your bank account or your brokerage account that, yes, in fact, you still have $100,000, it does not buy the same amount. And it's this invisibleness that is really interesting to me. And it was one of the reasons why I got interested in price charts, because before, why prices would go up, why they would go down, it seemed just all kind of random until finally I discovered price charts I think I was 16 years old. And it just was like this huge discovery to me. So I want to step back and kind of do a big picture and see what's happening in one specific area of something that we actually can't see, and that's inflation. Hey everybody, this is RC Peck, and this is my weekend podcast. And I know that inflation is not exciting, and everyone might be looking at the S&P 500 and wondering why it's down 4.5% over the last 7 days. But before we get into it, just know that we are in a trading range right now for the S&P 500. It has a flat 200-day moving average, which is never a good sign if you want something to go down or go up. There's always a lot of volatility and sidewaysness when the 200-day moving average is going sideways, and that is, in fact, what is going on right now. And the S&P has bounced off the 2100 mark 6 times this year, so there's a lot of resistance to that. And yet underneath that, about, depending on if you're counting it intraday or end of day, there's a 12 to 15% support way down below that 21% saying, no, stay above it. So we're going to have more back and forth. But with that, I want to look at grocery carts. And though I had to stretch out this image, so it's a little bitmapped, you can kind of get the idea that in 1972, $20 bought you what was in that grocery cart. $20 in 1992 bought you what is in the middle grocery cart. And $20 in 2012 buys you what looks like 2 or 3 items in the grocery cart. So our dollars, whoever's currencies, whatever country you're in, buys fewer and fewer things over time. And one way to measure it, well, one of the easiest ways to measure it is through how many groceries you can buy. Staples, not candy bars, but flour, vegetables, things that the body should probably have. So with that, I just want to show 3 price charts. And the first one is the Nasdaq, but I'm showing it to you inflation adjusted. So I'm adjusting this for inflation, and this price chart is 20 years. You're looking at 20 years of the Nasdaq. And back in 2000, the Nasdaq right here hit about 5,000. Now, you're not going to see the 5,000 over here because I'm taking the Nasdaq and I divided it by the CPI. Now, this podcast is not going to go into whether I believe the CPI is accurate or not accurate. I'm simply letting you know I took the NASDAQ returns and divided them by the Bureau of Labor Statistics, which I like to call the Ministry of Truth. I took their numbers of inflation and I divided the Nasdaq by that. And as you can see visually, here's where the old high is for the Nasdaq in 2000. Back in 2007, where it peaked, way, way, way below the peak of 2000. And even today, adjusted for inflation, the most recent peak we had in August is still 40% below the peak we had in 2000, adjusted for inflation. That's impressive. And when I tell people that we're in a contracting period, anyone who follows my work, the one strategy I have called long-term economic cycles, there are two main cycles in the investment world. One cycle where price-to-earnings ratios are expanding, and I sometimes call that the paper cycle because the best place to be is in the stock market. But really what it is an expanding price-to-earnings ratio. And then that's followed by a similar length of time where that PE ratio is contracting. It's getting smaller and smaller and smaller. And one of the easiest ways to see this is to take the Nasdaq or the Dow Jones or the S&P and divide it by the inflation rate to see that, in fact, there still is contracting happening. So you take the Nasdaq and you divide it by the CPI, the government's or the Ministry of Truth's kind of spoken word on what they think inflation is. And you see that the Nasdaq's definitely been underperforming people's money. If you put your money in the Nasdaq in 2000, you're still 40% below where it was back in 2000. That's amazing. But you have to actually divide the Nasdaq by the inflation rate to see this price chart. Sorry about that. My computer thought I plugged something into one of the ports, but in fact, I didn't. So very interesting. Now, this is not just the Nasdaq. Now, if we looked at the S&P 500, let me pull over the S&P 500. A little bit better or a lot better, inflated, adjusted for inflation. You can see that back in 2000, we were here, a triple top, inflation adjusted. 2008 didn't even come close. And here we are back in 2015. Looked like it was going to break above, but it broke below. That's pretty significant because that's called a false breakout. And false breakouts are very bearish formations. And so where this is going to stop falling, of course, I don't know. There's support under it. I'm not pointing that out on this chart. On other charts, I've pointed that out over the last many weeks. But just from a inflation-adjusted point of view, we could very well see this price drop down to the next major support point, which is this right here, which on this chart, it would be, let's just say the chart's at 8.15, and this would be 7.15. So that would be about another 12% drop before the market would stop dropping, which actually aligns quite well where there's about a very strong support on the S&P, about 15% below the 2100 mark. But adjusted for inflation, look at the S&P 500. Yes, it made it back up to this, but not without the help of a total of world money printing of $12.4 trillion. Pretty impressive. This is what you get for $12.4 trillion on the S&P. And then lastly, the actual best performing index of all three that I'm showing you here is actually the Dow Jones. If you look at it back here in 2000, it popped right back up to there in 2007, collapsed with everything else, and then broke above at the very end of 2013. So of the three, at least from an inflation-adjusted point of view, it is doing the best. And part of that, especially when it's compared, the Dow Jones is compared to the Nasdaq, it just didn't fall nearly as hard as the Nasdaq. And all things being equal, when things do fall, the mega cap stocks are generally considered the safer ones, so people have a lower likelihood of actually selling out of them. So the takeaway, inflation matters. You can't see it. It's not something that's talked about a lot, but inflation does matter. And oftentimes when I look at price charts, which are inflation adjusted, it gives me a different point of view of what's going on. And my takeaway when I looked at those three price charts is the S&P just had a false breakout, which is very bearish. Doesn't mean we're collapsing right now. The Nasdaq is 40% below from its inflation-adjusted high, has a lot of work to do to catch up. And the biggest takeaway from that is never take a catastrophic loss. That's the main reason why the Nasdaq is still 40% below its high. And it's also the main reason why the Dow Jones broke above its high in 2007 and 2000. And if you're bullish on the market, you want that inflation-adjusted Dow Jones to stay above that point. So guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.